Welcome to Trading Nation. I'm Mike Santoli. A huge rally in China's stock market failing to give equities in the U.S. a boost on Monday. Is this the start of a bigger turnaround for China? And what might that mean for our markets? Let's bring in David Rosenberg of Gluskin Sheff to weigh in on that. Dave, good to see you. Did anything change, I guess, in terms of the fundamental picture, government stimulus in China? It's been a big worry point for investors everywhere, whether there might be a little bit of a hard landing in China. So what do we make of the market action overnight?
Well, I think that when you can get a 4% bounce off of some hopeful words out of Beijing, because there's no real specific action, it just goes to show you how deeply oversold their stock market was. So that's the only information we have, is that there's a lot of short covering going on, giving you a bit of a technical bounce. I mean, we already had, the indication of some real stimulus out of the latest cut from the PBOC on reserve requirement ratios just about a month ago. And that's real stimulus, that's credit stimulus, and the market popped and then rolled over again. So this is really just a flash in the pan as far as I can see.
Well, beyond what it might mean for the Chinese stock market, I mean, as it kind of fits into the whole global economic picture, is China going to be just a drag in general on the economy? I mean, you have this big story going on about, decoupling of U.S. domestic economy and markets from emerging markets in China. Can that be sustained?
Well, I don't think that, the emerging markets or China are going to bring the U.S. economy to its knees. The U.S. economy is, broadly speaking, much more domestic. I mean, 90% of U.S. GDP is pure domestic demand. The channels would come more through the financial markets, the general tightening in financial conditions. So I think that's where you'd see, the real impact. We just have to go back, Michael, to 1997-98. The Thai baht devaluation triggered really a destabilizing detonation of a third of the world economy called emerging Asia. It didn't bring the U.S. economy down for the count, but you could see what happened to the financial markets in the summer of '98. So that's really the transmission mechanism. The impact will be felt much more in the marketplace in terms of credit markets and equity markets than really on any meaningful deterioration in GDP growth just from this alone.
When it comes to what the markets are suggesting about the U.S. economy and its trajectory, and I guess what sort of the broader consensus is, it seems like there's a little bit of static in that conversation, right? Because you have housing and auto stocks struggling badly, even semiconductor stocks, some retail way off their highs. So it seems like the markets are kind of bracing for some kind of a deceleration or something maybe even worse than that. On the other hand, credit markets in the U.S. are fine, and of course, a lot of the leading economic measures aren't necessarily flashing warning signals. So how do you make sense of all that?
Well, I think that you make a great point. Usually the credit markets lead the equity markets, not the other way around. Although in the past week or two, we started to see some notable widening in the high yield space. It could just be that there's still this lingering, stretch for yield that's helped out certain parts of the, what I would say is dramatically overextended corporate credit market. As far as the economy is concerned, I think you're right. We have cross currents on the high frequency data showing 4.2% second quarter. I would say close to 3% third quarter. I mean, who's going to quibble with numbers like that? But the markets inherently are forward looking. And a lot of the growth we're seeing right now is related to the fiscal stimulus, which is not something I would be expecting to influence the economy to perpetuity. And there's been a lot of pre-ordering ahead of the tariffs coming down the pike. So a lot of the stimulus we're seeing in terms of the economic data seem to be a little ephemeral. And my sense is that all we know about next year is that we're going to be seeing a big slowdown in terms of fiscal stimulus, a big withdrawal of fiscal stimulus, unless we somehow see this middle income tax cut, which probably isn't going to happen. But the one thing we know with certainty is that Fed policy hits the economy with lags that are long, variable, and insidious. And usually the lags are as short as 6 months, but as long as 18 months. And I think we're going to find next year is the combination of the actual and potentially further Fed rate hikes coupled with the balance sheet reduction hitting the economy and probably the markets pretty hard next year. To me, that's the real elephant in the room. Over beyond tariff and trade action is already the lagged impact of what the Fed's already done into 2019.
So then bottom line, you think that the Fed is either heading for over-tightening, some kind of a mistake, or they're kind of in the process of getting there?
Well, I think you hit the nail on the head. You know, my current slideshow is called, you know, the new paradigm. And then somebody in my recent speech said, you know, Dave, it should really be the old paradigm. And it is the old paradigm. I mean, what you just described, haven't we seen this before? If you look at like 60 years worth of data post-World War II, the Fed over-eases, then the Fed plays catch-up over tightens, then the Fed over-eases, the Fed over-tightens. I don't think anybody could argue that the Fed did not dramatically over-ease this cycle. And now we're paying the price in terms of the mean reversion towards over-tightening. And the bottom line is that, you know, recessions, I know it's a horrible word, but there's been 10 of them post-World War II. Thankfully, they don't happen every single year, but they do happen. And the Fed's thumbprints are all over every recession, by the way, and every expansion that we've seen over the course of the past 6 decades. So why would it be different this time?
All right, well, we'll have to see, or at least have to see how quickly that all might come about. Dave, thanks very much for joining us today. Appreciate it.
Thank you.
All right, thank you for watching Trading Nation. I'm Mike Santoli, and we'll see you next time.